Hi, it's the Tax Geek with more of your taxes oversimplified. In this episode, we answer the question, why is cancellation of debt taxable? Whether through foreclosure, repossession, or forgiveness of credit card or student loan debt, cancellation of a debt creates income for the person for whom the debt was canceled. Why is this? I'll try to explain as simply as possible. Let's just say you purchase a television for $750 and charge it on a credit card, and for one reason or another, you didn't pay the bill. After multiple attempts to collect the debt, the credit card company will often decide the debt is not worth collecting and write the debt off as uncollectible. When you purchased the TV, you acquired an asset worth $750, and the credit card company acquired your promise to pay for it, which is an asset called a receivable. When the company writes off the debt, it no longer has the asset, but you still have the television. In other words, you have received an economic benefit, a free $750 television from the credit card company. When you receive any sort of economic benefit that is not specifically stated to be a gift, that benefit is considered to be income. And since tax law states that all income is taxable unless Congress says it isn't, that canceled debt can be taxable. If an item is repossessed, it's a little more involved but works much the same way. In this case, you purchased an automobile for $25,000, but after a year of making the payments and reducing the principal to $21,000, you stop making the payments. The auto finance company then repossesses the vehicle and almost immediately sells the vehicle for $14,000. This has the effect of paying off part of the loan with the $14,000 the finance company received for the car. In this case, the amount of debt canceled would be $21,000 minus $14,000 or $7,000. Just like before, the $7,000 is an economic benefit to you because you had use of the car for the time you had it, and is considered taxable income. Whenever any debt over $600 is canceled, a Form 1099-C is issued to the debtor. Here's the 1099-C for the car repossession. On the left side is the usual information about the creditor and the debtor. Most of the right-hand boxes are self-explanatory. Box 1 shows the date the debt was canceled, and the amount of debt discharged, which in this case is the entire amount of $21,000, is in Box 2. If any interest is included in the amount in Box 2, it is shown in Box 3. In this case there isn't. Box 4 describes the type of debt, and Box 5 is checked, indicating the debtor was personally liable for the repayment of the debt. Box 6 is the identifiable event code, which for most people will be F or G. Code F indicates a mutual agreement between the parties that the debt will be reduced or canceled, and Code G indicates a unilateral decision by the creditor to discontinue collections. Finally, we have an amount in Box 7, which is the fair market value of the property that was repossessed. This amount is subtracted from the amount in Box 2 to arrive at the taxable amount of the debt cancellation. This is then reported on line 8 of Schedule 1 and transferred to line 8 of Form 1040. So, are there any situations where cancellation of debt is not taxable? Yes. Like most everything in the tax code, there are exceptions that make cancellation of debt not taxable, and here they are. If the debt was discharged in any sort of bankruptcy, cancellation of debt is not taxable. You should not receive 1099-C forms for debts discharged in bankruptcy, but if you do, you can claim this exemption. Cancellation of debt is also not taxable to the extent you are insolvent. In other words, to the extent your liabilities exceeded your assets as of the day before the debt was canceled. To see how the insolvency exception works, let's return to the example of the repossessed automobile, which just happened to have belonged to Donald. First, he adds up all his assets as of the day before the debt was canceled. These assets will include any cash he had on hand or in the bank, any retirement funds, the value of the asset being repossessed, and the value of any other personal possessions he has. His liabilities would include the debt that is being canceled, plus any other credit card, loan, or student loan debt he may have. If his liabilities exceeded his assets by at least $7,000, he can exclude the entire amount of the canceled debt from taxable income. If his liabilities had exceeded his assets by only $2,500, he would only be able to exclude that amount from taxation, and the remaining $4,500 would be taxable. If the debt was canceled through the foreclosure of a primary residence, the cancellation of debt is not taxable. This exclusion only applies to foreclosures prior to December 31st, 2020, unless Congress acts to extend it. Finally, if student loan debt was canceled because of the death or permanent and total disability of the borrower, it is not taxable. In this case, you should not receive a 1099-C, but if you do, you need to contact the lender and have them submit a corrected 1099-C to the IRS. To claim the first 3 exemptions, you need to file a Form 982 and check the appropriate box for the exemption you are claiming, and indicate the amount of the canceled debt to be excluded from income. You also need to put the same amount of the exclusion on line 10A for reasons I will explain in another video. So look for additional videos on insolvency and other topics involving cancellation of debt. In the meantime, if you need more information, there are a number of resources in the description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. Thanks for watching, and stay tuned for more of Your Taxes Oversimplified.